Term or whole life? Most people walk into this decision and walk out having bought the more expensive one, not because it was right, but because it was sold. By the end of this video, you'll decide in about 30 seconds, and you'll know exactly when each one is the right call. No pitch, just the actual decision with real numbers. The confusion around term versus whole life isn't an accident. Whole life pays the person selling it a much larger commission than term does. So there's a built-in incentive to make the cheap, effective option sound naive and the expensive one sound smart. I'm not saying every agent is steering you wrong. I'm saying the deck is tilted, and once you understand how each one works, you stop being steerable. That's the whole goal, to make you unsellable in the good way. Term life is the simple one. You pick a length, say 20 or 30 years, and an amount, say 500,000. Die during that window, your people get the money. Don't, and the policy just ends. That's it. And it's cheap because it expires. A healthy 30-year-old might pay $25, $30 a month for that $500,000 in coverage. The insurer's betting you'll outlive the term, and most people do. That's not a weakness, it's the feature. You're buying coverage for the exact years your family would be wrecked without your income. Picture a 32-year-old, two young kids, a mortgage. If something happens to them, the family needs the mortgage covered and the kids raised. But in 25 years, mortgage is paid, kids are grown, the income they'd replace is mostly gone. The need has an expiration date, so the coverage should too. Term matches that perfectly. Big coverage for $30 a month, exactly when it matters, gone when the risk is. Whole life is the permanent one. It never expires, and part of your premium builds a cash value you can borrow against. Sounds great, and that's exactly where people get sold. Honest version. Whole life is genuinely good at one thing, permanent coverage. Where it goes wrong is when it's sold as an investment. It builds cash value, like a savings account that grows. But that same $500,000 in whole life might cost $300 or $400 a month instead of $30. Run the numbers, and the cash value usually grows slowly, and you'd typically build far more wealth buying the cheap term and investing the difference yourself. That's the famous buy term and invest the difference, and the math is real. Take that gap, say $370 a month between the term and the whole life premium, and invest it in a basic index fund for 30 years. That difference alone can grow into hundreds of thousands of dollars, money that's yours, liquid, and not locked inside a policy. So when someone pitches whole life as forced savings, remember, it's forcing you into the slowest version of saving you could pick. So when is whole life the right call? Two clear cases. 1. You have a dependent who will never be financially independent, a child with a lifelong disability, for instance. The need never expires, so neither should the coverage. 2. Estate planning, where a permanent policy is a deliberate tool to pass money efficiently. For those, whole life is exactly right. What it is not is a clever way to invest. Buy it for permanent protection, never as a substitute for actually investing. Now the decision, in 3 questions. 1. Do people depend on your income? If nobody does, you may not need life insurance yet. If someone does, keep going. 2. For how long? A window, until the mortgage is paid and the kids are grown? Or forever? If it's a window, term wins. 3. Only if it's forever, do you specifically want lifelong coverage plus cash value? If yes, that's your whole life case. If you're just trying to invest, that's a brokerage account, not a policy. Income dependency, time horizon, permanent need. Most people land on term. 2 pushbacks. First, term is money down the drain if you don't die. So is every year of car insurance you don't crash. Protection isn't an investment and isn't meant to be. Second, lock in whole life young while you're cheap and healthy. Locking in early only helps if you actually need permanent coverage. Lock in the wrong product early and you just pay for the mistake longer. Match the product to the need first. Worry about timing second. So here's what I'd actually do. Run the 3 questions. Land on the type that fits. For most of you, that's term size to your high need years. Then get a real quote for that specific type, so you're comparing actual numbers instead of a sales pitch. Link below to start a quote. Answer the 3 questions first, then pull the number for the product you landed on. Decide from real figures, not from whoever's chasing the bigger commission. And if this made it clearer, the channel's full of these.